All right, what's up, everybody? Chris Rich here with the Realty Medics. On the line today, I have Nathan and Mike. They work for Green Summit Engineering. What do you guys do? Explain what that means.
You know what? I'm going to let my protege Nathan here take that question and throw that one out to him, and we'll see how he does. Go ahead, Nathan.
Yeah, absolutely. So Green Summit Engineering is an engineering-based tax services firm. We're based out of Cocoa Beach, Florida, and we work with real estate investors, developers, and anyone in the real estate industry to provide engineering studies that enable property owners, investment property owners, to depreciate their properties at an accelerated rate and save money on their taxes, in a nutshell.
Fantastic.
Perfect. I'm always proud of this guy. So I would also add to that we do 45L 179D tax work as well, in addition to cost segregation, which is the main topic of discussion today. Those other tax credits and deductions have to do with energy efficient buildings. So we do offer a wide variety of services based in that realm.
Perfect. Mike, can you turn audio up just a little bit on your end?
Yep.
There we go. All right, so jump right in. Houses depreciate over 27 and a half years per the IRS. What's the benefit to doing a cost seg over the standard depreciation each year in your taxes?
You're going to accelerate the benefit. So the IRS is telling you 27 and a half years equally spread out. You can take that over time. With cost segregation, generally we can, on a residential property, somewhere probably between 30%, maybe as high as 40% of the cost basis can be accelerated in year one. So there's a huge benefit there to doing that. It's time earned value of money thing, right? So we're talking about having your money today instead of spreading it out of those 27 and a half years. We're accelerating that benefit and get as much as we can in that first year.
That's one question that comes up for me when I start talking about this is, if I do a cost seg study, can I still depreciate the house in subsequent years for the taxes?
Absolutely, because what's happening is you're just taking a portion of that, right? So the remaining portion that you haven't taken can be depreciated throughout the rest of the schedule. So they call it segregation because we're segregating property in the building. Typically, we're looking at 5, 7, 15-year class lives. So those particular class lives are the ones that can be accelerated. And now bonus depreciation is something that came about as part of the enhanced tax benefit, which allows you to take quite a big chunk of that in that first year. It's being tiered out. So this year we're at 60% of that in year one. Year prior 80, years prior to that 100. So that 100% went away a couple of years ago, and we're slowly tearing down. So what happens in real life is that whatever you didn't take in those class lives gets depreciated on its own separate schedule. So yeah, you would still continue to write stuff off. Obviously, it's not going to be as large as it would have been because you took a big chunk of that in that first year.
Okay. Now let's say I have a rental property, I do a cost seg this year, and I decide to sell it, for conversation's sake, 5 years down the road. What's going to happen? Am I going to have to pay back any of that accelerated depreciation? What does that look like for the investor?
So yes, if you don't hold that house for the full period of time that you took that accelerated benefit on, so 15 years, 7 years, 5 years, whatever that is, you're going to run into a situation where you may owe some of that money back to the government. So generally we can math that out, and if the whole period is 3 to 5 years minimum, the whole process still makes sense. But on paper, that money is going to have to move back to the federal government if you don't have a long enough hold period. Under recapture tax. Yeah.
So like for my case, for example, with where my interest rate's out of my rental, I probably won't sell that thing for at least 15 years. So I need to, when I'm doing my cost seg, factor that in. But if an investor, maybe they're looking on that 5 to 7, they may want to have that planned out so they don't have to pay any of that back, right? Am I understanding you correctly?
I think what would probably happen is that they would get with their CPA, and the CPA is going to say, look, if the whole period is 7 years, here's the math, here's how all that works. So you still are going to take the benefit as you would as if you were holding it for a long period of time or a short period of time. But they're going to take a look at functionally what's going to happen to that money after that period of time and tell you if it's a good idea to move forward or not. And that's typically done by the CPA, not us, but we can certainly help math it out.
Okay, cool. You kind of touched on what's the common tax deduction for, let's say, a single family residence? How does that work?
So a good example of that would be an Airbnb, right? And this is something that we commonly run into out here in this market, Orange County, Brevard. So I would estimate 30%, maybe 40%. I mean, we're kind of in that realm. It depends a lot on the structure and what else they got going on and whether or not there was site work to the property. But generally, that's what I see in these reports that go out.
Okay. Let's say I have a brand new build. That's pretty common for us, for our investors lately. Buy a brand new house, plan to hold it. Usually they're looking to hold 5 to 10 years. When would you think would be a good idea to do a cost seg study?
So every property is going to be a little bit different, right? So general rules, 500K and above typically is what we're looking at as far as the purchase price is concerned. Brand new home, yeah, they would want to get that done as soon as they purchase the property. And this is assuming, of course, that it is a rental property and it's not a primary residence. You cannot use this technique for your primary residence. It's not allowed. So those are kind of generally what we look at in terms of what types of properties we would want to potentially engage. That doesn't mean you can't do it on a $300,000 purchase. I mean, you certainly could, but generally we won't get involved unless it's half $500,000 or more.
Okay. Which touches on a good point. You said it can't be a primary residence. It doesn't have to be a rental. What other criteria are we looking at to be eligible for a cost seg?
So anybody can be eligible for the cost seg, right? It's whether or not you're going to be able to take the tax benefits, another story. So there are some caveats there. One of them that we get into is whether or not you're a qualified real estate investor. So if you're a real estate agent, you're doing this moving property by virtue of your profession, you are a qualified real estate investor. The way that the IRS defines it, there's a number of caveats, but to keep it simple, you have to complete X hours of your year have to be dedicated towards real estate investing. So that's probably the largest component. There are others. Generally, this is a CPA question, then we'll push back, and the CPA will be able to go over everything and tell you if you're a qualified real estate investor, and you can take that.
Real estate professional, right? I think we're talking about the same thing, because there are a certain number of hours where you can qualify for real estate professional. But what if you're not in that criteria?
Well, then the benefit is not going to probably be there for you. So you can still have the cost segregation done. The benefit will continue to be there for you over the period of time. It just prevents you from taking that large chunk up front, which is really the reason for doing it, is to take that time or value of money concept. So for people that aren't real estate professionals, typically that benefit is not going to be there for them. Okay. Unless it's an Airbnb property. There are some caveats in the tax code that allow Airbnb properties with an average rental period of 7 days or less to qualify for that larger amount of bonus depreciation and accelerated benefit. And you don't typically have to fall under that qualified real estate professional designation.
Okay. Just going through these questions I had draw up. So we kind of touched on it. Can you cost seg the same property more than once?
You can, and it wouldn't be entirely uncommon for that to happen. So if you take an example of improvements to the property, let's say you buy this thing and you dump off $500,000, $200,000, whatever, into the property after you purchase it. So you have the original cost segregation done on the building as is, then we would come in a lot of cases, do a secondary cost segregation study on what you put in, and then provide dispositions on what was taken out. And then in those situations, yeah, you would have 2 cost segregation studies done on the property.
So like one question, speaking with someone recently, one of my investors, and he brought up, what if I buy this old distressed property, but I don't want to do a full renovation right now. So I'm going to do a partial renovation, get it in service as a rental, and then maybe down the road, 3, 5, 7 years, finish the renovation. So that would be one of those situations where, kind of depending on circumstance, it may be worth it to do it multiple times, but it really depends on the material changes you make in the renovations. Am I understanding that correctly?
Well, I think it's important to note that a lot of this is going to be dependent upon the in-service date. So whenever you purchase the property, if it's immediately you begin renting it out, we want to be there. You want to have the cost segregation done before you put stuff in there. So we want to be able to see it and document what's there as part of the report. If the in-service date is not until after you've done that initial set of improvements, we would want to come in then after the in-service date and those initial improvements have been done, and then do the cost segregation at that time. But we always want to get in there shortly after the place is in service in order to make sure that we properly document what's there, because you have the ability to take dispositions on stuff that you pull out of there in many circumstances, and we want to be able to show it was there first.
So if I'm following that right, let's say I take, for simple conversation, a $200,000 house, I put it in service, and then 3 years later, those tenants move out, and I do $70,000 worth of rehab, do a mostly complete rehab. Do another cost seg then, or would you still have to wait another 2 years, or is it really circumstance dependent?
I think it would be more circumstance dependent because there's a lot of other stuff that can be going on. So there was caveats to the tax code that we would probably want to discuss in that situation. But I would say in most situations, in most cases, we want to do the cost segregation study right after the stuff's done. So if you paid $200,000 a house, we'd want to get out there after it was on service, on the market, ready to lease, however you got it going on. And then immediately after that person moves out, 3 years later, we will come in and do the other one.
Okay.
Yeah.
Is there a benefit to using higher end materials when you do a renovation specifically for cost seg purposes? Because generally for us, we tell our investors, don't spend the most amount of money on materials for a rehab because you're generally not going to see that ROI in the monthly cash flow rental rate. But could it make sense if your plan is to do a cost seg where spending more materials may be worth it, or is there kind of a happy medium? Because we've seen it before where it's like we spend top dollar for granite and this and that, and the house is really nice if you were to sell it, but the renters don't care that you spent that much money on granite. So could there be a way for those investors that may have made that mistake to recoup some of those costs through the cost seg?
It's entirely possible, and you can't really make a blanket statement about the quality of the renovation materials that you're using because each individual item has to be looked at and classified depending on where it's going to fall. So if you spend a bunch of money on something that's going to always be in that 27.5-year class life, that doesn't help you or hurt you over a whole lot, right? But it can help you clearly if you spend a lot of money in these 5 or 7, 15-year lower class life categories because they're going to be accelerable. So generally what we'll have people do is send over a budget. What are you looking at doing, as complete as possible, or the contractor's pay application after the work is done. We can take that and work backwards and give a benefit analysis, which of course we provide free of charge. So for us to run the numbers for you and tell you what it's going to look like, that's an easy thing for us to do, and we don't charge for that.
Can you give me some examples? Because I'm just sitting here listening to you talk, and I have a little bit of an idea, but what kind of things are in the 5-year class life, the 7-year class life, and the 15-year class life? What kind of parts of the house are we talking about?
Yeah, Nathan, why don't you talk about the 5, 7, 15-year class life properties?
Absolutely. So the 5, 7, and 15-year class lives have a little bit of nuance on them, especially between the 5 and the 7-year. But to break it down the most easy way possible, the 15-year class life is going to be set improvements. So it's going to be things like landscaping, signage, these types of things. So say for an Airbnb property or a rental, if you were to have landscapers come in and completely redo the front of the house, where you're doing all this mulch, plants, all that stuff, every plant in there, all that mulch, pavers, anything like that, asphalt, concrete, those are all going to be 15-year class lives. And then the 5-year is going to be income generating things. So things that are directly increasing the income of the property, meaning the light fixtures within the property that are outside of building code, any sort of specialized equipment, really nice cabinetry in general, these sorts of things. And then 7-year is a little more nuanced, and that's really something where the engineers, that's why it's great to use an engineering firm for it, right? Instead of a CPA firm, is that our engineers are able to determine for the 7-year property where exactly that's going to fall. And that's actually something that I would defer to Mike to a little bit more to give a more in-depth explanation about the 7-year class life. But yeah, so the engineers are able to determine the 5 and 7-year class life difference, but generally it's going to be, I'm not sure for a single family home, but for like a hotel, for example, manager's office, a lot of the equipment in there would be a 7-year class life.
Generally, we don't see a whole lot of that. So of that 7-year class life, it's almost never there. So it's typically that 5-year and that 15. So those are all classified by the engineer, kind of calculated that way.
I kind of stepped on you bit, Mike. You said for single family residences, the 5 and the 15 is more beneficial, whereas 7-year may be more applicable to a commercial, which needs to be my next question. What types of properties can you do a cost seg study on?
So residential stuff is probably the biggest thing in your world, whether it's multifamily, whether it's a single family rental. That's the most common type of real estate investor is probably residential stuff, but you can do it on just about anything. So warehouses, we do a lot of those. So strip malls, skyscrapers. I mean, there's not much that we can't go in and cost seg out. We've done an amusement park, practice facilities for college, and some really old stuff too. So buildings built like that 1800s, we can even go in and cost seg that stuff out. It's a little more tricky for the engineers because those building techniques aren't well used anymore.
Okay.
So, but we can do just about any type of commercial property or residential rentals.
As long as it's in service as a rental.
Correct. It can't be single family. Yeah.
So what if it can be, but it just has to be a rental, right?
I'm sorry, it can't be primary. It can be primary residence.
It just can't be a primary residence. So let me ask you this question. What if I have a duplex or a quadplex? Do all of the units have to be renovated, or do they consider it one unit for the purpose of cost seg? Say I have a quadplex. I have 2 of the 4 units are actively rented. I'm in between tenants on the other 2. Would that still be considered in service if it was a rental, but I'm just in between tenants?
There's CPA methodology here to confirming the in-service date, so we'll just speak kind of generally.
Okay.
Once it's available for rent or lease, typically that's considered an in-service date.
Okay,
if we get like this unit is out because we can't do anything with it because we've got to clean it up or something, and these other 3 are rented. That's a CPA question. There's a test that exists within the IRS code that you can help determine whether or not you're still able to take that whole building, or you can only do 75% of it that year and 25% the next year. But that would be an unusual circumstance to even see that going on. Typically ready for rent, you're good to go.
Yeah, it's my understanding, for my CPA, as soon as it goes in service and becomes a rental, they, kind of treat it as those vacancy periods. It is still a rental until that material status changes. So I was just curious, obviously there's a lot of commingling here with, doing cost seg and having the CPA and everyone being on the same page as far as the investor's plan and what's the plan with the property. So let me ask you this. What are some downsides to doing a cost seg study?
Recapture tax. If the whole period's not long enough, that's really the only thing that comes to mind is dealing with that recapture tax. I always tend to look at it as, even if you do have to pay that recapture tax after 3-year period, just know that it's going to happen, right? Because you're still got 3 years of that additional money that can work for you, right? Whether you're investing it in the market or whether you're investing it in additional real estate. So I think that's probably the biggest downside would be managing and dealing with that recapture. And then at the end of that period, as you're depreciating things out, those additional months after you take that big chunk are going to be less than they would have, right? So your year 2, 3, 4, you're not getting that chunk anymore. So everything's going off over this 27.5-year schedule. So that number is lower than it would have been had you not done it at all. But I don't know that that's even super relevant, right? Because you're going to take that big chunk up front.
Is it like a sliding scale as far as the recapture period? So if I do the cost seg and I sell it in year 2 as opposed to year 5, as every year passes, is my recapture, obligation lower with each passing year, or is it kind of year by year is the same amount? So how does that kind of work? Or can you speak to that at all?
Yeah, we're getting close to the line. So we're not a registered CPA firm, so it's probably
no worries. Can't answer, don't answer.
Yeah, I would say that generally what you're thinking is what I understand to be true. Yeah.
Okay. So really, to go back to the points, like having a good CPA and having a good engineering firm that can cost seg it, where they're working together, is kind of the best approach. Because then you can, as the investor, I can say, hey, this is my plan with the property. I'm going to hold till retirement 20 years from now, or hey, I want to be in for the appreciation in Central Florida for the next 5 to 7 years, and then maybe 1031 it. Having those conversations and kind of laying out that plan up front sounds kind of like what I'm seeing is the overall goal. Would you agree with that?
I would, and I would also say that a lot of times it's better to approach a company like us directly. It's not uncommon for us to work with CPA firms that use our product, and maybe there's a little markup there sometimes. So
Okay.
I would encourage your listeners to come see me, come call us first before you go to your CPA and say, hey, I need a cost seg done, because they may just call us and charge you extra. I don't know what's happening there.
So let me ask you that. Let me say one of my clients right now says, hey, I was really intrigued by the video. I want to get more information on this, and I give them your number. What's that going to cost them?
Nothing.
Okay. What if they decide to move forward with the cost seg? Let's say it's one investor, one rental property, in service, single family house right now. What are they looking at to do a cost seg study? Ballpark it.
How big is this house?
Let's say 2,000 square foot house. Most of our clients are between 1,500 square feet, 2,000 square feet house.
For your people, Chris, I think we could probably keep it in the $3,000 range.
Okay. Well, what kind of return are they looking for that money? Because for a lot of our investors, it comes down to the numbers. If I've got, let's say, I'll use a common ballpark, right? Most of those houses we have under management, a lot of our investors are between 1,500, 3 twos, 4 twos, 1,500 to 2,000 square feet. House values generally speaking, between 300,000, 350,000. That's going to hit a lot of our clients. What are we looking at on cash back, on the deductions or the credits? If we're paying that $3,000 for the cost seg study, what am I looking back next year for taxes?
So you're going to take that $300,000 purchase, and the first thing that we want to do is estimate a land value, because you can't depreciate land. So that has to be removed from this calculation. So let's just say 20%. Generally, that's a fair number in most markets. So that leaves us, if we take a $300,000 house, $240,000 left, right? So if this is the depreciable basis, in other words, we're not talking about a scenario where we've got a 1031 exchange in play. If we do, the 1031 exchange does affect the basis calculation. So take those away. So you got this $300,000 house. We took 20% out for land, so we're at $240,000. Now, let's say we estimate that we're going to get about 30% of that number in those segregated class lives. So we got about $72,000 there. Now, because this bonus depreciation concept is being tiered out, we're at 60% of that this year. So you're going to get 60% of this $72,000. So that's a $43,000 deduction on the taxes.
So what I'm hearing is it sounds like a good idea, generally speaking.
Yeah, absolutely. And our benefit analysis are going to include all of this information. There's also going to be a net present value calculation, which kind of helps you determine if you stuck this money in the market, what would happen there, the money for the study. So it'll all be drawn out, nice, neat, graphs, charts, couple of pages, easy to look at, and it takes no time to pull together. We can turn one of those around in a day.
Okay. And what if, because this has come up before, obviously you take it, your CPA takes the booklet that your firm does, gives it to the IRS. What happens if the IRS says, hey, wait a minute, something's not right here? What does that look like for the investor?
So what we have seen happen is the investor gets audited. Now, the IRS has made it clear doing this cost segregation technique in and of itself is not enough to cause an audit trigger. So if you've got some other stuff going on and you get audited, they're going to say, hey, where's this report you put in here that you have? And they're going to say, oh, it's right here. They're going to take that. They're going to tail through it. We have never had an audit question by the IRS. We've been audited by third parties and never had a question. I think the real benefit of having an engineering firm doing the work is that you don't run into those type of situations where someone's going, hey, this report is garbage. We don't know the methodology. We don't know what happened. And then they throw it out. Then you've got fines, penalties, interest, all kinds of nasty stuff from the IRS. So, our reports are signed and sealed by a professional engineer. We also include an extensive amount of court case information as to how and why we do things the way we do whenever we're depreciating these assets. Unfortunately, there's not just a book you can go to and say, hey, I can figure out how to depreciate this property and what needs to be classified, because there's so much court precedent that also comes into play whenever we're looking at the methodology. So I think that's really the benefit there of using a firm like ours and having that defensible position with the IRS in the event that it got questioned.
Which, to go back to something you said way earlier, makes me think, obviously we talked about some of the tax benefits for green updates and energy efficient, things of that nature. I'm thinking for the investor who may be doing a fix and flip or fix and hold, I should say. Could you get some of those benefits if I'm green efficient with putting energy efficient windows in or things of that nature, even on the single family residence, or would it not really apply?
I don't know that we've ever done any work for single family residence, one off kind of stuff. If it's a
Okay.
spec builder and they're building 250 homes, it might math out to go for some of these tax deductions or credits that are available. If we're talking about a larger residential property, multifamily, yeah, some of these things are available out there for those type of buildings, but little quad, duplexes, single family home, probably not.
Okay. Just scroll through here, see if I got anything that. Question I missed. Let's say Nate did a cost segregation study on a house 5 years ago, and I'm buying that investment property from him. I put a renter into it. Can I still cost seg the house year one?
Clock resets with the new owner.
Okay. Well, that's good to know.
Yeah, this is kind of an odd thing with this depreciation, right? Because you think about a car and it's just going to depreciate over X number of years, and it's going to be functionally obsolescent. It's not going to work anymore. Well, like I said, we could go do a building built in the 1800s. Who knows the cost? There could have been 20 cost segs done on that building from the time that this became something that was part of tax code to the day. But yeah, it completely resets every time a new owner takes possession.
Interesting. Yeah. So, where does the appraised value, like the value from? We were pulling up fake, numbers there. Were we pulling those numbers from property appraiser website? Are we having to pay to do an appraisal? Where are those figures coming from?
So generally, when we're talking about a single family home, and it sounds like that's probably most of your folks that are listening, we would just go to the property appraiser's website and pull up the information about the home. Most of it's typically on there. Obviously, if it's a new purchase, we won't know that. You have to provide that information. But most of what we need in order to pull together a benefit analysis can be gleaned from the property appraiser. Primarily, we're looking for land value there. So it's not so much the land value number itself, it's the percentage of that number of the overall price of the building that we look at. So we're going to say, okay, this thing is 80% building and improvements, 20% land. And that's the number that's going to go into the benefit analysis. That's the methodology that appears in the tax code. In lieu of some substantial, like an appraisal. Maybe had a land appraisal would be very unusual for a single family home to have a specific land appraisal, but that would be a preferred methodology to go in and doing a comparative analysis on the tax collector's website. But 90% of the time, that's what we use.
What if I'm thinking like, all right, I buy the house and say it's an old distressed property. I'm doing a full rehab. County says the house is worth, just for numbers, like $200,000, but I put $80K into it, and I know that the comps in the area, it's now worth $450,000. Would that be a case where paying the appraiser, an independent appraiser to come say, yeah, this house is valued at, some $450,000, subtract the land value? To me, it seems like if we're talking about the cost, if we're talking about an additional $100,000 in actual market value, it might be worth it to do an independent appraisal. No?
We don't care about the appraisals. All we care about how much you spent out of your pocket. So what did it cost? What was the improvements? How that affects the value in the overall market doesn't come into play whenever we're talking about cost segregation.
Gotcha. So if I took that same $200,000 house, I put $80K into it, you're looking at $280K, not the $450 on the rehab. Or after the ARV, after repair value. Gotcha. Yeah. But may not be a bad idea though, because from an appreciation standpoint, you still have that value of the house if you do sell it 3, 5, 7 years down the road. So I guess that kind of goes back to the overall, what's the plan for the property?
And what's the play there usually, Chris? Hey, take that extra money, pull out equity out of the house, go buy another one, right?
I would say so. Yeah. I'm a big fan of safe debt leveraging and asset leveraging, and that's kind of where I wanted to film this videos, because I had a surface idea. Nate and I have had some conversations, and I know a few investors that have rental properties that had never done it. They started asking me questions. I'm like, I don't know. Let me get with the guys that do know to do this for a living and see what kind of answers we can come up with.
Well, I think you just touched on an interesting point there too. We can go back in time and do these as well. So if you've got real estate you've purchased over the last 10 years, we can take that portfolio, go look up all the information we need, and create a benefit analysis that will show the catch-up depreciation available to you. A good example, kind of on a larger scale, is we work with a company out in California, and they hadn't cost segged any of their commercial buildings, and there were hotels and strip malls and all kinds of stuff. So they were up against a nasty multi-million-dollar tax bill they were trying to figure out how to mitigate. Well, it was easy for us to go in and take a look at everything that they had and do a benefit analysis for each property. And at the end of the day, we were able to wipe out that money that they owed the IRS by accelerating depreciation on those assets that they hadn't already taken it on. So this is also true with single family homes. So it's not uncommon for us to get a call because somebody's paying a $30,000, $40,000, $50,000 tax bill, and they heard a cost segregation. Oh, maybe these guys can help offset that. And in many cases, we've been able to provide reports that substantiate this accelerated component of depreciation and get that tax bill wiped.
Yeah, because like my now rental, they renovated it before we bought it, and it was our primary, and then we transitioned it. So I'm curious to see what we're going to get back deduction wise. Because nice granite countertops, nice cabinets, there's a lot of stuff done, but I didn't have the value for that. So I guess that's where you guys come in and say, yeah, these were updated, and that's where my CPA wanted, the breakdown of what was done when, and like material things that I had done to improve the property.
Yeah, those 1,000 moving pieces, right, that comprise our tax code. That's another interesting thing to point out too. You're not going to find one person that knows it all, right? There's too much information there within the tax code. So we spend a lot of times educating CPAs, and we're actually licensed to train them for continuing education on this topic. So as a company, we have a tremendous knowledge base and speak to this stuff all the time. Yeah, and I really enjoy working with those CPAs a lot of the time. Educating them is a fun part of my job. I'm the bum who used to be an insurance agent, coming in here, telling them how to be CPAs.
So this makes me wonder, like if I have a property, I do, we want to make our properties, especially in our Central Florida competitive rental market, I want to make my property more marketable. In the multifamily, it's a little bit easier. You can add amenities as a whole, apartments and things of that nature. But maybe I want to make my single family house more marketable. Are there things to do on a cost seg benefit side that, like if I did a garden or made a nice patio addition, Nate, you touched on the 15-year appreciation. If I add a nice covered, screened-in patio in my head, like before this conversation, I wouldn't normally suggest that. But if I could get some pretty substantial ROI there, would that be a good idea?
Absolutely, yeah. Throwing a pool with a covered screen enclosure, we'll depreciate all of that. And
hold on, because pools are one of the worst ROIs investments for a property. So
I thought we were talking appreciation, Chris.
We are, but I mean, we're going to cover both sides. So now go on.
Right.
What are you saying there?
But yeah, absolutely. So that would just be something to sit down with one of us to talk about, because most of the things you just mentioned are all going to be site improvement, right? So we're going to be able to accelerate all that stuff. So I'm not a professional at long-term or short-term rentals. So it would have to be something where it's like, okay, I think I can make X amount of dollars by doing this. I can increase my monthly rental rate. And I say, okay, well, this is what I could save you in your first couple of years of having that. And we could work out that math together. So can't say it myself, but absolutely there's a situation where that might become more worth it when otherwise it's not.
So now this
you a tax affected savings of $20,000 on your $100,000 pool. Does it make sense still? I don't know, maybe not.
maybe not, but I'm thinking again, going back to the overall strategy, right? If the pool adds loosely 30% value to the house, or as far as ROI, you're going to get $30,000 more on the house if it is a $100,000 pool. But if I'm getting $20,000 back and I'm going to hold it for 10 years, typically pools add between $200 and $300, generally speaking, to a rental rate, house to house. So maybe that additional long-term play, you may break even. And definitely, especially in Florida, and especially for a short-term market, if you don't have a pool and a short-term rental, forget about it. But on the long-term side, a lot of people do want pools. So that's an interesting caveat that I never thought about until this conversation. So,
well, and you asked about marketability on a home that's for sale, right? So it's not uncommon for us to partner with commercial real estate agents, brokers, and provide them these benefit analyses on the properties that they're selling. So if an investor is looking at it, you've got this engineering company saying, look, if you buy this house for this price, your anticipated tax deduction is X. And in particularly larger properties that have offering memorandums, you will find cost segregation information in there about the property, because rich people rich by not paying taxes.
For sure.
And a lot of that strategy is through accelerating this depreciation. It's probably one of the most straightforward, easy things for them to do, is buy enough real estate they can offset their tax burden.
Which is what Robert O'Leary talks about all the time. And I don't know if you saw the clip recently. He was on whatever platform it was, and they were talking about Trump and not paying taxes. Not to get political, but Robert O'Leary is like, every person who owns investment real estate, they find ways to utilize the tax code the way it's written. And, they're all doing it. There's a reason why 40% of millionaires got there through real estate. So I think the number's higher than that, actually.
Yeah, I think it's close to like 70 or something.
Yeah. And obviously, I think it's like billionaires is the change. Well, either way, is there anything I'm missing that you think is important information? Actually, I want to touch before we go to that, but you talk about dealing with the real estate agents, doing a benefit analysis. What do you mean by that? Because I work a lot with agents. I think it would be a good tool for my investor-minded agents.
Yeah,
You're
so
saying
we have a partnership program that we've developed where there's an opportunity there for a bit of a referral fee. Obviously, this is something we do for free, right? So it doesn't cost anything for us to provide this. And once that goes over to the broker, our expectation is that they'll offer the handshake. So if it's the selling agent, we hope that that information in there will yield a sale for us, and the new purchaser will come and talk to us. And if it's the buyer, we hope that they'll see our benefit analysis in the offering memorandum and go, wow, this land value in this area is only 6%. I can depreciate the other 94% of this, and I have this huge value here. Oh, this is awesome. I'm just trying to save on taxes, and this is one of the 10 properties I like. I'm going to pick this one.
So hold on. I think if I'm understanding you right, let's say I'm an agent and I'm trying to sell this short-term rental. It's been in service. I have this data for the occupancy, the ADR, all that beautiful data. I can come to you guys and you could say, hey, with this property as a short-term rental, here's what you're looking at for cost benefit as the rental through the segregation. Is that am I following you right?
Yeah, absolutely. So if I'm the buyer coming and looking at your property, you give me all this data and you also stick this cost segregation estimate in front of me, and I'm going, okay, well, this is an engineering firm saving. I can write off another $50,000 in accelerated benefit on this property. This is great. So it's just an opportunity for that to be a bit more attractive. And I can tell you, my experience shows us that Airbnb market is traditionally underserved by the CPA community, because generally those CPAs have these discussions about these enhanced tax strategies with higher end properties. They may have in their mind a number of $1 million. We're not even going to talk to them unless it's $1 million and up. We're talking about $300,000 homes, no problem. But it's probably something most people in that investment world haven't heard about. If we're talking $300,000 single family homes or duplexes or whatnot.
Yeah, because something I'm seeing right now, I'm just trying to think of a way to help my clients. We've had a lot of calls in the last 3 months of people that bought into short-term rental market, and now with it went from like 24,000, I think. Don't quote me, but it was from 24,000 short-term rentals to like 30,000 in like 18 months. Down in the Kissimmee, Davenport area in that surrounding metro. So a lot of those people got in when the market was great for short-term, but now it's like, man, I'm barely covering the bills. This is a lot of work. I'm thinking the cost seg might be a way for them to help kind of save face in a lot of ways. If they're breaking even or losing a little bit of money, that cost seg may give them that nugget, of reserve, if you will, for the property to kind of get through the tough times right now, or even wait it out till the appreciation goes a little bit up so that they're not, losing their, on the asset they bought it 8 months ago and are looking to sell now.
Yeah, Chris, I'm tracking, man, and I think that's an excellent point. And again, that's something I'm happy to crunch the numbers on anytime.
Because there was a client I was literally on a phone call yesterday. They bought the house in May last year. They're break even or losing money each month, the mortgage, but they're going to be a couple $100 under the mortgage as a long-term rental. And I always tell people, kind of deviate from it. Like, if you're going to do a short-term rental, always run a long-term rental analysis for this exact reason. Unless you're getting one of those 10, 12 bedroom houses that is never going to be a long-term. But I was kind of talking to him about, hey, cost seg may work for you guys depending on your strategy. And I'm actually going to make sure that he gets this video. But when I told him my idea, I was like, you may get 20, 30, 40 grand back that you could put aside and hold the property, rent it out long term. And that money set aside is going to help you not lose money, and then factor in, the tax benefits going forward. So it's I'm really excited to be able to share that information, there's a lot of people in that situation right now.
Oh yeah, I've heard, and we're getting calls as well over here on our end with this Airbnb community of people trying to figure out what they can do to balance the books in a positive direction. So yeah, I think we will probably continue to hear more and more as the word is slowly disseminated that this Airbnb concept is something that you don't have to be that qualified real estate professional in most cases in order to take advantage of that enhanced benefit. And there's a lot of technical jargon as to exactly why that is the case, which I'm happy to send to anybody that asks. But my understanding is that in most cases, you'll be able to take that benefit.
Awesome. So what did I not cover? What needs to be said? I feel like we had a lot of good conversation. It might have got a little mundane at some points, but I feel like there's a lot of good information here. What did I miss? What did we not cover?
I think that we were pretty thorough, man. I think we got the meat of what we wanted to kind of go over today. And yeah, I'm just happy to be a part of this podcast. Thanks for inviting us on. And always we are happy to take a look at a property. So it really doesn't take a whole lot of time to say, nope, this is not a good idea. Or yeah, this is probably going to work. Let's spend some more time and develop that benefit analysis. So we're happy to help whoever we can.
So if I've got an investor who wants to get in touch with you guys and see if it's a good idea for them, how do they get a hold of you?
Give them Nathan's cell phone.
All right.
Yeah,
Seriously, hey, what's the cell phone number?
Call them, text them. Yeah, we can put that out there. Email is always great. That works too. Nathan and I both live on our phones. That's our just primary method of communication, not only because the office phones all route to the cell phone, any other type of digital reach out is going to come to the phone. So that's really the easiest way to get in touch with us.
Yeah, I actually regularly tell my investors that if they wake up at 2 a.m. sweating about their cost segregation study, they're welcome to call me. So I'm always open on my phone.
What's the number, Nate? Where do we reach you?
Yep. So it'll be area code 223-225-6595. Nice and easy to remember.
And what's the email?
It's me, nathan.orr@Green Summit Engineering. And I'll send that all over to you too, so we can attach it.
I'm going to put in the notes for the video. So, gentlemen, I appreciate your time.
I would add one more caveat. I better say this before I get in trouble by somebody. I can see peeking into my office. So let me give you the office number as well, in case you ever want to call here. That's 321. I don't even know it. It's 321-273-2202. That's my extension. If you call that, it'll go right to my cell phone.
Perfect.
So feel free to reach out.
All right. Thanks, guys. Have a good one.
Thank you. Have a good day.